This is Chapter 6, Video 1. Let's launch. Okay, so in this video, we're going to talk about common deductions necessary for calculating the required adjusted gross income, or what we also call AGI. So there are basically three deductions for categories for AGI. This is for AGI, in other words, above the line deductions. Directly related to business activities, indirectly related to business activities, and subsidizing specific activities. So directly related to business activities, and when we say business activities, we're talking not only about businesses, which is going to be expenses that are going to fall under Code Section 162. We're also going to be talking about production of income activities, which are going to fall under Code Section 212. And so you're allowed to deduct expenses incurred to generate the business or production of income. And for tax purposes, activities are either profit motivated or motivated by personal objectives. So if they're profit motive, they're going to either be trade or business, or they call them investment activities. Actually, in this case, most investment activities like this are going to be called production of income. So, for example, rental properties, royalties, and the like. Although motivated primarily by profit, business activities are distinguished from investment activities because trade or business require a high degree of involvement and effort from the taxpayer, whereas investments or production of income don't. So, for example, when I was running Beta Solution CPA back before I elected as an S Corp, what happened is that this was a Schedule C. I was very involved in it. I got to take deductions on it directly against my income, and because it was my first year, obviously I lost money, which is typical of any business. And so I got to be able to do that. Now, investment activities involving investment of property or appreciation for income payments. Basically, so the way the IRS kind of looks at it for production of income, if you are doing a rental property, the whole purpose of you doing it is that you're looking for the appreciation of the value of that property is sort of the big thing. Or if you have property out there that's got oil on it and you decide to let the oil companies come in and take away some of the oil as a result of it and give you a royalty payment for that, you're looking for the appreciation of that property primarily. Now, does that mean that you're not going to get taxed on the income that it generates during that time? The answer is no. You are going to get taxed on that income, but you're going to be allowed to take specific expenses against that as you're doing it, but it's going to be somewhat limited. So, for example, I, as a business owner, if I take a trip to Las Vegas to participate in the AICPA conference that usually happens there once every year, I get to write that off as against my trade or business. But if I attend a landowners convention in Las Vegas, I won't get to write that one off. So there's going to be some limitations that happen as a result of that. These are going to be some individual business and investment related expenses. There are deductions for AGI and from AGI and non-deductible. They divide them in these categories. I'll let you read this, and you can look at my smiling face while you freeze this and take a look at that. I know I'm starting to look like the Joker, aren't I? You know, why so serious, son? All right. So, trade or business expenses must be directly related to business activities. In other words, if I have my CPA firm, but then I also have I have an expense that has nothing to do with my business, but maybe when I go to Las Vegas, I also check on a rental property maybe I own there. There's going to be a portion of that trip that I have to allocate to that rental activity that is going to be non-deductible, but the rest of it is going to be deductible. Another example of this is I went to a CPA convention in Denver probably about 2 or 3 years ago when I first started Beta. And one of the things that happened is I also visited my half-sister that I recently discovered. I didn't even know I had a half-sister at that time. And so I went to go meet her, talk to her, and see some certain portions of that. I actually just went and had dinner with her, so it wasn't that big of a deal. But if I went out there and I spent an exorbitant amount of time, for example, 2-3 weeks, and I had only gone to the conference for a week, I'm going to have to allocate some of that to personal expense, which is going to be a non-deductible expense. That'll be a question that you ask your taxpayers when you're filling out their tax returns. Hey, this business trip, did you have any personal use of that business trip? Well, yeah, I went to Hawaii. I went to the conference in Hawaii, but then I was there for 2 weeks afterwards. It's kind of just, messing around, having some fun. What ends up happening is that a portion of that is not going to be deductible as a result of that. It has to be reasonable in amount, not extravagant. In other words, if I get the presidential suite out there, and I live currently in a regular home, that's going to be seen as extravagant and probably not going to be deductible. Again, these are questions you need to ask your taxpayer. Expenses that are claimed on Schedule C, revenues from the same activity are reported on the same Schedule C. So you'll see this with some taxpayer. I have one taxpayer that I do his tax returns on. He has 4 activities. And as a result of having those 4 activities, what ends up happening is that I have to bifurcate out, or actually in his case, quadricate, because quadricate by, if you don't learn your Latin, there it is. So I quadricate out his expenses in order to be able to split his expenses up to the 4 ways. Sometimes he does one trip that covers 2 activities. We split it out between the 2 activities. It goes against them. I guess in an aggregate sense, if you accidentally put it on one Schedule C but not on the other Schedule C, it's not a big deal. But if you don't separate out personal expenses, it is a big deal, and you want to make sure that you're actually taking care of that appropriately. Rental royalty expenses, those that are claimed for that are above the line because they're going to go on Schedule E. That's E is an echo. They should be either investment or trade or business based on facts. So if you are a person who engages in rental activities as your primary profession, so for example, you're a real estate developer, that'll typically go on Schedule C, but some of the properties could go on Schedule E depending upon their uses, depending on facts and circumstances. Generally, the big deal is that if it goes on Schedule E, it's probably not going to be subject to self-employment income tax, and as a result of which you won't calculate that. So you need to make sure that you appropriate it correctly in order to get that. Taxpayers are going to report it on Schedule E, transfer of net income, and all that sort of stuff. Flow through entities. So if you are a partner in a partnership, you'll get a K1. You attach that to your return. All the items that flow from the K1 onto your personal return, you'll pay taxes on, depending on the use of the partnership. So if it's an investment partnership, there's not going to be any self-employment tax. But if it's a partnership where you actively engage in a trade or business, you will have to pay self-employment tax on that. And you'll know that because you'll look at K1, box 14 will actually have all the information. Box 14, code A and C will tell you the information that needs to happen in order for that to take place. Losses, taxpayers doing business that have losses are allowed as a deduction for AGI, meaning above the line. So losses from investments called capital assets offset capital gains. If you have excessive losses over the gains, you'll be able to take up to $3,000 on your tax return immediately, and then you take the rest of it and go to the next year, and you go against other capital losses or capital gains that they have. They don't have any more, $3,000 more, and then goes forward one more time. I know all these wonderful sound effects, almost like I'm Hollywood. Excessive business loss deduction. So if you have an excessive business loss, in other words, it says here if it's married filing joint more than $518,000, you're not going to be able to deduct it immediately, but the portion of that that's carried forward will carry forward indefinitely. So say I lose $1 million in 1 year. I'm going to take $518,000 against my income today, but the rest of it's going to carry forward to next year. Now, most cases, if they're losing that kind of money, chances are the only income that they're actually receiving is from this business. And so you don't have to worry too much about all that. It's not going to cause that much of a deal. But if you have a situation where one spouse owns a business and it loses a lot of money, but then the other spouse, say, for example, is a high-powered lawyer, doctor, or whatever, and makes, $500,000-$600,000 in salary, you might lose some ability to be able to take some of that deduction against that, which means that they will still have a taxable tax return. Health insurance deduction by self-employed. So here's the thing. This is probably the biggest mistake I see on most tax returns. People who try to take the health insurance, and what they do is they don't put it in the right place in the tax return, and so it doesn't get calculated correctly. You get a deduction for income taxes for health insurance paid for yourself if you are a self-employed individual and you have access to no other health insurance anywhere else. Okay, let me say that again. You get a tax return deduction for income taxes on your tax return for health insurance you buy for yourself that you don't, when you don't qualify for health insurance anywhere else. This is a big problem that I see with veterans because we qualify to go use the veteran medical system. That means that I can't take the self-employed health insurance deduction as a disabled veteran. I get to go to the VA system. I get my health insurance. I get health care out there for free. So the IRS basically says, well, then why are you going out and buying additional health insurance for yourself? You don't get to take a tax deduction as a result of that. Ergo, it doesn't show up on your tax return. It actually will go on Schedule A, and then you can take a tax deduction there. But I've seen where a lot of people say, oh, I'm self-employed. I'm also retired military. I have TRICARE, but I buy other health insurance because I need it because, my nearest military base is, say, 4 days away. You don't get a deduction as a result of that on the front page of the schedule return. You'll go as a from AGI deduction. In other words, below the line deduction on Schedule A. So self-employed insurance, self-employed taxpayers can claim personal health insurance premiums for the taxpayer's spouse and the taxpayer's dependents if they're under the age of 27, but only to the extent that business income is derived from the specific trade of business. So if the business loses money, you don't get a deduction off of it. And so what ends up happening is we'll put that on Schedule A so that it can actually go as a deduction against any other income that they might have. Although remember, actually you guys probably don't know this yet because you haven't watched the other video at this time, but basically what ends up happening is the medical deduction for that is actually subject to a very significantly high floor, which means they may lose a lot of the deduction as a result of that. So you want to make sure that it goes on the front page of the return if you can qualify for it, but you got to make sure that you qualify for it under the rules that they have. Self-employment tax deduction. So here's how it works. Every one of us who has wages pay self-employment insurance tax. So you have 6.2% for Social Security, 1.45% for Medicare. You pay that. Your employer pays the other half of that. When you are the self-employed individual, the IRS never goes without. You will pay both portions of it, the employer version and the employee version. The employee version is not tax deductible for you because you don't get a tax deduction as a wage earner. Why am I going to give you one as a trade or business? However, the employer version of that, in other words, one half of it, is tax deductible. And so that'll actually go on the front page of the tax return under the self-employment. And that's when you take a look at it. You see self-employment taxes of $10,000. You'll see a $5,000 deduction on the front page of the tax return. You're also going to do deductions for individual retirement accounts. We talked about this in a previous video where there's like traditional IRAs, 4A, which is above the line deduction. Distributions are taxed as ordinary income. Early distributions are subject to a 10% penalty. There are some waivers around this, and you might want to look. If a client tells you, I pulled out $20,000 from my IRA in order to go to college, there's certain waivers that you can get in order to avoid some of that 10%. If you can avoid it altogether, you might be able to do that too. Non-deductible contributions can be made to retirement plans, but you have to track the basis on that. And that's on Form 8606, and you'll fill that out as part of a tax return. I have a couple clients that I have to do this on an annual basis. Make sure the 8606 is correct, and then kind of move on from that. Penalty from early withdrawal of savings. So if you have a CD, for example, I take $40,000, I put it into a CD for 3 years or two. Actually, probably I think it goes to 1 year increments and 2 year increments, and then goes to 5 years. So let's say I do it for 5 years, but after year 3, I need the money, so I pull it out of that CD early. As a result of which, the bank's going to charge me a penalty because they said, we gave you higher interest expecting you to keep this with us for 5 years, and you didn't. So we're going to charge you a penalty with that. You then get to be able to take the deduction on that penalty on the front page of your tax return. It doesn't happen very often, but it is something that if you hear that they took it out and they said, hey, I had an early withdrawal from one of my CDs, this could be a tax savings that you can offer to your clients. It would be very useful. Alimony payments are deductible for AGI, in other words, above the line, if paid pursuant to a divorce decree before 2019. We've talked about that in the previous video when you're including the income. This is where the other half happens. The spouse receiving the alimony payments, they got divorced in 2017. They got to pick it up in income. They got to pay taxes on it. So you want to make sure that you're following that. Contribution to a retirement account are deductible for AGI to encourage savings. Now, we don't talk about retirement accounts too much in this class, but there's a wide variety of them. SEP IRAs, simple IRAs, simple 401ks. There's a lot of things that business owners get to be able to take on that. It's not deductible for social taxes, but it is deductible for income taxes. And so that's why they take it on the front page of the return there. Taxpayers are allowed to deduct for AGI certain items subject to limitations, interest for qualified education loans and qualified education expenses. This always kind of blew my mind because, if you take out these massive loans in order to be able to go to college and become a doctor, I think you should be able to take the deduction regardless of your income. But that's just me. Again, if I was made the tax god for a day, one thing I would probably change. But it is subject to the certain AGI limits that you have to deal with. So those deduction on qualified loans. These are the limits. It's up to $2,500, and then it's subject to these income limits. You have to figure that out. Okay. Summary limitations on deductions for education loans. Here's a good chart that you can take a look at. It's similar to the charts. It's similar to the charts that I would have here in my Quick Finder. And of course, it's actually so something that I've had in the past. Client makes $400,000. They give me their student loan interest. They're like, "Why don't I get a deduction? You made too much money." And then you have to kind of explain to them and then listen to them gripe about how politicians don't really understand things. I mean, this is just kind of a normal thing that we have to deal with in the business. And I don't care if they're liberals or conservatives, and I listen to them gripe. It's kind of like, okay, yeah, no, I completely agree with you. This is ridiculous. I don't think, and you want to sympathize with them, but, at the end of the day, the law is the law. You got to do what the law says, and that's kind of how that happens. All right, so this is for phase outs for if you're married filing separate for those student loan deductions. Qualified education expenses up to $4,000. Now here, actually, let's step back for 5 seconds on this. You're gonna when you find out somebody did qualified education expenses, you're not going to worry too much about how this gets deducted. And I know that sounds kind of like, then why the heck are you teaching this to me? Let me tell you how you're going to do this in the tax system. In my tax return preparation system, and I know this on UltraTax, CCH, and Go system does all the same thing. I'm sure the other systems do the same thing too. You're going to have a little button that you're going to be able to toggle saying, hey, take the best of all three. Okay. So you're going to consider the deduction for AGI. You're going to consider the AOTC, which is the American Opportunities Tax Credit, and you're going to consider the Lifetime Learning Credit. Tell me which one works out best for my client. Okay. And that's how they're going to calculate it. But as far as for like the test and what they're allowed to do, these are the things you're going to have to know. And again, if you have a situation where a client says, hey, I paid all this tuition, I made $400,000, I don't get an education deduction, why not? This is going to be kind of the slide that you're going to want to reference in order to be able to show that to them. All right, folks. Wow, that was 16 slides. Boy, we got to the end, and I'm looking forward to our next lesson, and I hope to see you there soon. Thanks.